If you've been investing in mutual funds for a while, you would have noticed a trend. A fund house suddenly becomes popular as multiple schemes start topping the chart simultaneously. For instance, investors flock to Quant Mutual Fund as many of its schemes delivered impressive returns. Before Quant, we saw the same happen with Axis Mutual Fund and Mirae Asset Mutual Fund. At present, it seems that Motilal Oswal Mutual Fund is probably going through the same phase. Almost all actively managed equity schemes of the fund house are toppers in their category. For example, Motilal Oswal Midcap has delivered 64.23% returns over the past year. It is the best performing midcap fund in this period. Invesco India Midcap is the second best with 49% returns. Now the category average return of midcap funds are 38.51%. That's half of what Motilal Oswal Midcap Fund has delivered. Now the trend is similar for Motilal Oswal Large and Midcap Fund, Flexi Cap Fund and ELSS Fund. And as it usually happens, investors have started flocking to these schemes. Most of Motilal Oswal's funds are now twice their size from a year ago. In fact, the assets under management or AUM of the Midcap Fund has grown from around 7,400 crores in December 2023 to 23,000 crore in November 2024. That's a 200% growth. So what is the reason behind this performance of the fund house? We will try finding in this video. Hello and welcome to ET Money's YouTube channel. In today's video, we will try to decipher the reasons behind the stellar performance of schemes by Motilal Oswal Mutual Fund. We will also examine each fund's portfolio to see if there is a pattern that has led to these four funds outperforming their peers. We will explain what has worked for these funds. Now, this video will not only tell you about the growing popularity of the Motilal Oswal Fund House, but will also provide insights into how the fund management team makes investment decisions. So make sure you watch this video until the end. But before we begin, a quick update. You are watching this video on our English channel. हमारा एक हिंदी चैनल भी है जहाँ पे ये सारी वीडियोस आप हिंदी में देख सकते हैं. And if you are interested in basics of finance, we have a channel called 5 Minute Finance. I've attached their links in the description below. So do check them out. Alright, first let's briefly discuss the investment strategy of the fund house. The fund house employs an investment strategy they call QLGP. So what is this QLGP? It's an abbreviation where Q is the quality of the business and its management, G is growth in earnings, L is the longevity of both quality and growth, P is for price, meaning buying stock at a reasonable price. So, fund managers across the fund house look for stocks with quality management and good growth prospect at a reasonable price. Now, this doesn't provide specific insights into the investment strategy. So, we look deeply into the portfolios of the four actively managed diversified equity funds of the fund house. We saw four patterns common to all funds. Let's discuss them one by one. All the funds have a highly concentrated portfolio. They invest in around 30 stocks or less, which is far lower than other funds in their categories. Take the example of Motilal Oswal Flexi Cap Fund. The fund has just 17 stocks in its portfolio. On the other hand, the average number of stocks for Flexi Cap category is 81. Now this stands out as Motilal Oswal Flexi Cap Fund is not a small fund by any measure, as it has around 12,600 crore assets under management. Now much smaller funds in the category are more diversified than that. Take Shriram Flexi Cap Fund as an example. Despite having an AUM of just 141 crore, it holds around 58 stocks. Now, it takes a lot of conviction to take highly concentrated bets like Motilal Oswal Flexi Cap does. That's because if 4-5 stocks perform well, the scheme's returns would jump considerably. However, if the stocks fare poorly, the fund could be among the worst performers. Now, is this strategy risky? Well, it's a high risk, high reward strategy and seems to be paying off for now. But whether it will continue to do so in the future is anyone's guess. Okay, now let's move to the second interesting pattern we found. First, we looked at the portfolio overlap among the four schemes. We found that four funds, Midcap, Flexi Cap, Large and Midcap, and ELSS fund have four stocks in common. These include Kalyan Jewellers, Zomato, Trent and Coforge. Each fund has allocated at least 1/5 of its portfolio to these 4 stocks. Over the past year, these companies have delivered excellent returns, which have helped the schemes. For example, Zomato has delivered a return of 394%. Both Kalyan Jewellers and Trent have delivered over 130% returns. Now, ideally, if all 4 funds are topping the charts, the portfolio overlap should be higher. It's difficult for any fund house to have unique stock investment across different funds, and each of those funds outperforms its peers. So we dug deeper. We were surprised when we compared the portfolio of Flexi Cap with the Midcap Fund. Both funds have 10 stocks in common. The Flexi Cap scheme has an 80% allocation to these 10 stocks in its portfolio. Meanwhile, the Midcap Fund invests 70% of its assets in these 10 stocks. Now we further check if this was the case recently, or these 2 schemes have held the same stocks for a while. Now this has been the case for at least the past year. We then compared the portfolio of the other 2 funds. The large and mid-cap and ELSS funds too held similar stocks. Surprisingly, the number of stocks common to these 2 funds are even higher. The schemes had 28 stocks in common. Now, ELSS funds have allocated 90% of their portfolio to these common stocks. On the other hand, the large and mid-cap fund has invested 87% of its assets in these businesses. So, if the portfolio are similar and the stocks do well, all funds will outperform simultaneously. This is one of the reasons why most funds from Motilal Oswal Mutual Fund are topping the charts. However, such overlaps are not unique to Motilal Oswal Mutual Fund. You will see this trend in other fund houses as well. After all, the research and investment management team is the same in every fund house. They have the same view on the economy, sector, market and businesses. So overlaps do happen. That's why investors should diversify across fund houses. Okay, let's sum up what we talked about so far in this section. There are some stocks common to all 4 funds. However, the Flexi Cap and Mid-Cap funds have a significant overlap in stocks. The same is the case with ELSS and Mid and Large Cap funds. These investments have done well and so have the funds. Okay, let's now talk about the third observation. Motilal Oswal is among the few fund houses that takes unique bets. This means the AMC has invested in stocks that are overlooked by other AMCs. Again, such moves require high conviction. In its October portfolio, Motilal Mutual Fund has 14 unique stocks. No other fund house has investments in these businesses. Now, Motilal Oswal Mutual Fund is not the only fund house which takes such unique bets. Fund houses like UTI Mutual Fund, Quant, and SDFC have a higher number of unique stocks. However, none of the funds invests heavily in such unique stocks. Motilal Oswal has significant investments in these businesses. Take the Flexi Cap scheme as an example. It invests 83% of its portfolio in just 10 stocks. The average allocation of the category is just 8.67% to the top 10 stocks. So while others may play it safe by diversifying their portfolios, Motilal Oswal Mutual Fund takes a significant position in stocks that it thinks will do well. Finally, let's move on to the final observation. As per conventional wisdom, mutual funds should buy and hold most of their stocks for the long term. If a fund buys and sells stocks frequently, it's considered risky. Now we looked at the turnover ratio to understand how frequently a fund buys and sells stocks. A higher number means frequent buying and selling. Also, a turnover ratio of 100 means the fund has churned its entire portfolio in the past year. Now in the case of Motilal Oswal Mutual Fund, 3 of the 4 top performing funds have seen higher portfolio churn. Each fund has a turnover ratio of over 100. The large and mid cap is an exception here. Now this tells us that the fund manager don't stick to the traditional buy and hold approach. They enter and exit stocks as and when they see an opportunity. This is commonly seen when a fund house is focused on either growth or momentum investing style. Okay, let's now move to the last part of this video. So what does all this mean for investors? Schemes from Motilal Oswal Mutual Fund have done well, and there is no reason you should not evaluate them for potential investments. But make a note of 3 important aspects. 1. The concentrated portfolio makes it a risky proposition. 2. The stocks in the funds are similar. In such a case, investors should typically avoid investing in multiple schemes from the fund house. Finally, understand that outperformance doesn't last forever. We have seen schemes from fund houses like Quant, Axis, and Mirai Asset outperforming their peers in the recent past. However, after a while, the outperformance stops. Some other fund house shoots into prominence. You must regularly track their performance if you invest in actively managed funds. And this brings us to the end of this video. I hope you found this useful, and if you did, please don't forget to share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.